Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Today, we're tackling something maybe not always top of mind in the boardroom, but absolutely critical: working capital management.
That's right. It's fundamental.
And we're kicking off with this paradox that jumps out from the sources. You can have a company, right? Revenue's climbing, profits look great, stock's doing well, and then boom, suddenly liquidity just vanishes. They're bankrupt. How on earth does that happen? Profitable on paper, but dead in the water.
Yeah, it seems counterintuitive, doesn't it? But it nearly always comes down to the difference between being profitable and actually having cash, the culprit.
Yeah.
Weak working capital management, or WCM. You see, profit is about long-term value. Working capital, that's about surviving next week. If you sell a ton of stuff, but all your money is stuck, like in unsold inventory or tied up in invoices your customers haven't paid yet, well, you've got a ticking time bomb. Paper rich, cash poor. That's the classic trap.
Okay, so it's the short-term health check.
Exactly. The basic definition is simple. Current assets minus current liabilities. It just asks, can you pay your short-term bills with the assets you can quickly turn into cash?
Got it.
So this deep dive, our mission really, is to unpack this whole daily cash battle. We'll look at how giants like, say, Apple and Walmart absolutely mastered it, turned it into an advantage, and also what happens when companies lose that focus.
Right. Understanding that operational heartbeat. You know, we often talk about revenue growth like it's a marathon, this long, sustained effort. But the sources really frame working capital differently. If revenue's the marathon, working capital is the sprint.
That's a great analogy.
You have to keep winning these short bursts day in, day out, just to stay in the long race.
Precisely. Your WCM position dictates if you can make payroll, pay suppliers. If you have positive working capital, great. Your current assets are comfortably larger than your liabilities. You've got a cushion.
Okay.
And that cushion lets you handle surprises, maybe invest opportunistically, or just ride out a slow month.
And the flip side. The danger zone the sources mention is negative working capital.
For most companies, yeah, that's a huge red flag. Massive liquidity risk. If your suppliers demand payment before your customers pay you, you're basically insolvent. Doesn't matter how much profit you expect to make later.
So it's about timing.
It connects directly to something called the cash conversion cycle, the CCC. Basically, how long does it take from spending cash on resources to getting cash back from sales? A long cycle means your money is tied up. Weak companies, they see that cycle break down, can't turn stock and receivables into cash fast enough.
Okay, so finance teams aren't just watching one number. They're juggling different elements constantly.
Right, it's like spinning plates. You've got four main levers.
Right.
First, obviously, cash, actual money, the lifeblood. Then you have three areas you're always trying to optimize. Accounts receivable, that's the money customers owe you. You want that faster.
Speed up collections.
Exactly. Then inventory your product sitting there. That's cash on a shelf. You want to turn that over quickly.
Well, optimize turnover, yeah.
And finally, accounts payable, the money you owe your suppliers. Strategically, you want to slow that down, within reason.
So the goal sounds simple. Get cash in faster, move goods out faster, pay bills slower. But simple doesn't mean easy, right?
Not at all. The execution is where the mastery lies. And think about the scale we're talking about for global companies. Shifting payment terms by just a few days, on either side, that can unlock huge amounts of cash.
We're talking millions.
Millions, easily, sometimes billions. It turns the finance department from just, scorekeepers into a strategic source of funding for innovation, for growth, whatever the company needs.
Okay, so let's talk about the masters then. Who really cracked this code? How did they turn WCM from just like a necessity into a real weapon?
Well, the true masters are the ones who've flipped the script, essentially. They managed to get their suppliers to finance their operations. It's like getting an interest-free loan from your supply chain.
How does that work?
The classic case study is Apple. Famously operates with negative working capital. Now, usually that spells trouble.
Right, we just said that's the danger zone.
But Apple makes it work because of, well, speed and power. They get cash from customers. Almost instantly think iPhone pre-orders, App Store sales, paid up front. Then they use their immense size and influence to stretch out payments to suppliers, sometimes 60, even 90 days or more.
Hold on, if negative WCM is so risky for almost everyone else, why isn't it for Apple? And aren't their suppliers furious? I mean, they're essentially bankrolling Apple.
That's the key point. It's strategic negative WCM. Suppliers put up with it because the sheer volume of business Apple provides is massive and predictable. Losing Apple as a customer, that's often unthinkable.
So it's the leverage.
Exactly. Apple dictates terms, and that cash generated internally. They plow it straight into R&D, into new products, without needing as much external debt. It's a huge competitive advantage. A moat, really.
Okay, that makes sense. Scale is power, and we see that elsewhere too, right? Companies focused on logistics and volume.
Absolutely. Look at Walmart. Similar dynamics. They use their massive buying power to negotiate really favorable payment terms with suppliers.
Right.
And they combine that with super efficient just-in-time logistics. They aim to sell the product and collect the cash before they even have to pay the supplier for it. Lean inventory, stretched payables,
Yeah.
generates enormous cash flow.
So it's not just about negotiating terms, it's also about moving the goods fast.
Definitely. And think about manufacturers. Toyota in just-in-time, it wasn't just about factory efficiency. It was about minimizing cash tied up in parts sitting around.
Sure.
Go back to the 90s, Dell. Their whole build-to-order model was designed to eliminate finished goods inventory. Massive boost to liquidity, allowed them to scale like crazy. We see similar things with Amazon's cash cycle optimization and even Tesla managing supplier terms aggressively during its big growth phase.
It really is turning an accounting concept into strategy. But, okay, let's flip the coin. Even big, successful companies can stumble if they lose that WCM discipline. What happens when things go wrong?
Yeah, this is where the growth trap often appears. A company's growing fast, looks great on the surface, but their need for cash outruns their ability to generate it. Receivables balloon because they're selling more, inventory piles up to meet demand. But they still have to pay suppliers. It scales faster than payables. They're constantly chasing cash, often resorting to expensive short-term debt just to keep the lights on.
And what are the common mistakes that lead to this? Just bad luck.
Sometimes it's external shocks, but often it's internal discipline failures, like simply overstocking inventory due to bad forecasting. That cash is just sitting there getting old. Or being too generous with credit terms to win a sale, but then not being tough enough on collecting the money later.
The sources pointed to Kraft Heinz after their 2015 merger as a major example. What went wrong there? It wasn't just sales, was it?
No, it was a classic WCM breakdown. They ended up with bloated inventories, receivables collections slowed right down.
Yeah.
It just got out of control.
Well, and the impact.
It wasn't just numbers on a page. It showed a real failure in leadership focus. Maybe too much focus on cost cutting after the merger, not enough on keeping the operational cash cycle tight. That weak WCM led directly to serious cash flow problems.
And that resulted in the dividend cut in 2019.
Exactly. A very public, painful signal that they couldn't fund themselves reliably anymore. It hammered stakeholder confidence. We saw issues at GE around 2018, too long receivables, struggling units putting strain on working capital and overall liquidity. The lesson is stark. WCM discipline isn't optional, it's survival.
Okay, so for the finance pros listening, let's get practical. What's the playbook? How do you move from just surviving to actually weaponizing WCM like the best companies do? What are the key strategies?
All right, 5 core strategies really stand out. It's all about speeding up cash coming in and managing cash going out. Strategy 1, tighten receivables. This is often the low-hanging fruit.
How?
Clear payment terms up front. Electronic invoicing to speed things up. And crucially, actually enforcing late payment penalties. Or incentivizing early payment.
Like offering a discount for paying quickly. Can you give an example?
Sure. A common one in B2B is 210 net 30. Means the bill is due in 30 days, but pay within 10, and you get a 2% discount.
Right.
The seller gives up a tiny bit of margin, but gets cash now, which is often way more valuable than waiting or borrowing money.
Okay, makes sense. What's strategy 2?
This is the delicate part. Negotiating payables. Trying to extend your payment terms. But you have to be careful. It's a balancing act.
Walking a tightrope, you called it earlier. How do you do that without ruining supplier relationships? They need to get paid too.
It's about being a reliable, predictable customer in other ways. You pay when you say you will, just maybe that's at day 60 instead of day 30. You communicate clearly. The companies that mess this up are the ones who are erratic, delay payments randomly.
Yeah.
That destroys trust fast. You leverage your reliability.
Got it. So receivables faster, payables slower. What else? 3, 4, 5.
Strategies 3, 4, and 5 are heavily into operations and tech. Third is streamline inventory. This means better demand forecasting, often using AI now to know exactly what you need when you need it. Minimize the stuff that sits around unsold. Cut that cash tied up in boxes.
Okay. 4th.
Centralized treasury management. especially for global firms. Get visibility across all your bank accounts worldwide. That way you can move cash where it's needed most instead of having pockets of idle cash just sitting in different countries doing nothing.
Right, making every dollar work. And number 5, technology.
Yes, fully used technology. This is transforming everything. Automated systems for tracking receivables, AI for that demand planning we mentioned, supply chain finance platforms that optimize payments for everyone involved. It's about speed, accuracy, and increasingly prediction.
And that predictive element connects to the final piece, the sources stress. Scenario planning.
Absolutely critical. It's not enough to be optimized for today's conditions. You have to model the what-ifs. What if your biggest customer pays 15 days late? What if a supply shock forces you to hold 20% more safety stock?
Stress testing the cash cycle.
Exactly. Just like you stress test the balance sheet for long-term solvency, you have to stress test the WCM cycle for short-term resilience. It builds preparedness for turbulence, which is inevitable.
Okay, let's bring it all together then. What are the big takeaways?
Fundamentally, WCM isn't just accounting jargon. It's the difference between survival and failure, regardless of how profitable you look on paper. The best companies, your Apples, your Walmarts, they master it and turn liquidity itself into a weapon funding their growth.
While others learn the hard way.
Others, like Kraft Heinz showed, learned that neglecting WCM discipline doesn't just slow you down, it actively destroys value and forces incredibly difficult choices.
So we know profit matters long term, but liquidity pays today's bills. Here's a final thought for you to chew on. Think about the companies you deal with every day, your suppliers, your customers. How well are they managing their cash cycle?
Because their WCM performance directly impacts your own financial health, your own risks.
And consider those tech tools we talked about, AI and demand planning, automated finance platforms. How is that technology fundamentally reshaping cash flow efficiency right now? And what does that mean for who wins and who loses in your industry?
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.